All right, welcome back, everyone. So, this is the second episode of Decoding the Algorithm. Today, I'm going to talk about the time based model, uh, about the bias. Yeah, so in episode one, we learned that the market isn't random and it's run by an algorithm that hunts for liquidity. We also saw how a messy chart can kill your confidence, your bias, you miss a trade. And in this episode, we are going to dive into the first pillar of our objective trading strategy. So, this episode is going to be really important. This is where things get interesting because I'm going to show you how time gives you a massive edge. So let's get into the presentation. So let's do a quick recap of episode one. So in episode one, we talked about how the market is driven by an algorithm and its main job is to clear out liquidity. We also agreed to throw out all of the messy, unnecessary indicators and focus only on three objectives: that is price, time, and candles. So now let's get into the time part. So you might be thinking, why does time matter? Well, the algorithm isn't just randomly active. It's programmed to be the most active very specific times. As you can see on the chart, we have the Asian session, the London session, and the New York session. And you can see the New York session. This is Nasdaq, by the way. You can see that it's the most volatile. It has the most volume. Um, so these are the moments, sessions where major institutions and banks are executing huge orders. So it's when the liquidity is at the highest, and it's when we see the most volatility, right? So, as I said, on New York, it's the most volatile. See, there's a lot of volume happening in it, and this is the prime time for our strategy. So, let's start with the bias. So, finding your bias. These are timeframes that you need to be using to actually find bias. Um, I'm only going to be talking, this whole course is going to be about, uh, I guess you're trading prop firms. So I'm going to talk about only from the perspective of trading prop firms. But if you can keep your trades more than 24 hours, then you can trade more safely on bigger time frames. Um, just because I am trading on prop firms and probably you are also. So we are going to be focusing on smaller time frames, but still the weekly, monthly, daily is going to be in our favor. So our time frames are monthly, weekly, daily, 12 hours, 8 hours, 6 hours, 5, 4, 3, 2, 1, 90 minutes, and 30 minutes. And our entry time frames are 15 minutes and 5 minutes. Here's an example that just happened recently. You can see on the daily time frame, we have this bullish candle, and none of these candles closed outside of this box, the range. So from the wick, lowest wick, to the wick high, none of the candles closed outside of it. So this becomes our target if the high candle has been taken out. So if you are looking for longs here, you will be stopped out. So we need to follow the direction of a bigger time frame. So looking at 4 hours on this exact example, we have smaller ranges. As you can see on 4 hours, we have this range right here. We have this range, this range, this. You can see that none of these candles closed above the range. So this candle closed inside, took out the liquidity from here, and reversed and took out this liquidity. So you can see no candles really created a new range. They were all trading inside of this candle's range. You can see the sell side of this candle hasn't been taken. This candle didn't take the sell side. So this remains as still as a range. There hasn't been a range created yet. But looking right here, this candle closed also inside of this candle, but it created a new range because this candle was made. This candle took out this liquidity right here, and it created a huge wick right here. So this becomes our next target after the buy side liquidity has been taken. If sell side liquidity would be taken, then possibly we would be looking for longs. But as we know on the daily range, we are in a downtrend. So in this scenario, if this liquidity would be taken, then we would not be looking for longs because we know the daily range is bearish. Same thing as here. This candle took this liquidity, but as you can see, the third candle did take out this liquidity right here. So best case scenario, we should wait for this candle to form, and then we should be looking for shorts. Same thing goes for here. This candle closed inside of this candle, and you can see it took out this liquidity, but it didn't create a higher high, and it didn't take out this liquidity. So this becomes our new range. It took the sell side, but it becomes our new range. And as you can see, the next candle, what did it do? Took out the high of this new range. What did it do next? Fell down and took out this range right here, the sell side. And even here, we had a new range also. So buy side got taken, sell side also got taken. Same thing goes for this one. Also, the high got taken out, so this becomes our new target. And the sell side also got taken. You can see if you look at this candle, the next candle took out the buy side and the sell side also. So this would be our new range also, because this candle took out also the buy side, this candle, and this candle took out the sell side. It might seem hard to understand, but I will be going over the examples on a real chart. So you should understand it more better. So anyways, let's get into the chart and I'll show you how to find this and mark it out correctly on your chart. Okay, here we are on the chart. Let us go from the monthly. As you can see on the monthly time frame, this is our range. You can see this candle took out this candle's high, and this low still remains intact. So our target would be this low right here. Let's go on a weekly time frame. Same thing again. We have this candle right here. This candle took out this candle's high, range high. So our target would be this candle's low right here. Let's go on daily time frame. So same thing is happening right here also. Let me just make this better so you can understand. So this was our monthly right here, monthly range. This was our weekly range, and this is our daily range. Let's go to 12 hours. Same thing is going on. The high got taken out. I mean, the candle did close above the range, but like it's not that much, like 50 points only. So this still remains as in the range. So let's go to 8 hours. Nothing happening really on the 8 hours. 6 hours, 5 hours, 4 hours. Well, still take uh, our take profit, but still our bias remains bearish because everything is working as it's supposed to be bearish. And on 4 hours we can see the turtle soup did happen here, 4 hour range. As you can see, let me just check. Yeah, okay. So we had this candle right here. This candle took out the wicks high, it closed inside of the range, and this candle took out this candle's low range. So going into 3 hours, 2 hours, 1 hour, you can see how it played out. Here we had a turtle soup. This was an intra turtle soup, and still on 1 hour is the same thing. As you can see, this candle took out the high, still remained in this candle's range. The next candle took out this range low. So let's see how we could have traded this day. So here we have the 7 a.m., the 8 a.m. Let's go to 9 a.m. Okay, this drops down to 15 minutes. Let's go 9:30 a.m. right here. Okay, 9:30 a.m. Here we go. We took out this liquidity right here. So 9 a.m. didn't create a new higher high. So this remains as our higher high. And we want to see now this candle be taken out. And as you can see, we took out this high also. So now let's look what happened on 8:30. There you go. So on 9:30, we created a higher high. What happened right here? Turtle soup. So TS. So we could enter right now already. But I usually like to wait for the next candle. There you go. So this would have been my entry just always wait for that confirmation. So there is our entry, and you could target the 50% of the 4-hour range. So for me it is this blue line, but I am going to target, I want 3. You could target the end of it, but the 50% has a higher win rate, but I am going to go for 1 to 3. So let me play it out and let's see what happens. There we go. As you can see, this candle took out the 50% and then kind of went back up. Still the price followed through and took out this 4-hour low right here. So basically, this was just a really good trade. Of course, this doesn't occur daily. These type of clean trades you cannot catch daily. And yeah, we can go over some maybe for more examples. 265, 265, 265. I mean, same thing right here. I mean, not as clean. But still. 2 a.m. I mean 6 a.m. candle didn't take the high, but it still is in that range. 10 a.m. took the high. Let's actually go to this one, and 2 p.m. took it out. So let's go to 15 minutes and see how we could have traded this. So there you go. So we had this high right here. And as you can see, this candle, 10:15, took the high. Let me actually drop down to 15 minutes. So yeah, as you can see, this candle took the high out. And if I take my fib and draw out the 50% again, you can see what the price did, right? So turtle soup. What happened right here? We have intra turtle soup. So you could have entered right here on this candle, your stop loss above these the high right here, because we don't want to see it get turtle souped again, and targeted the 50% of the candle. That was at 10:15. Let's look what happened right here. 12:05. The full range got taken. Maybe there were news or something. I don't know. There we go. This candle. 12:05. Went high up. Turtle souped. So turtle soup. What happened right here? Intra turtle soup. And same thing again. This bearish order block. Short. Push our stop loss above. And yeah, you could have targeted the 50% for 3:15, or just the end of this range. Okay. Let's go again to 4 hours. Once again, 4 hours is the best one to search for these type of trades. Going down to smaller time frames, you have to be a little bit more experienced. but it works also. I mean, even if you go 30 minutes, you can see right here, you can see it happening a lot of times. Why am I putting text? This range didn't get taken. You can go to the select right here. This high got taken out. Slow got taken out after. Here you go. What happened right here? Now this is on 30 minutes. This candle took out the high. Next two candles took out the range low. Took out this low also. Same thing right here. This really didn't work out. But yeah, you just have to be a little bit more experienced to catch these type of trades. Here you go. There's a perfect example. There you go. So the time-based entry. So again, our entry model is based on waiting for a specific event at a key time. The best setups do occur around the London Open. For Nasdaq, it's at 3 a.m. EST, or the New York Open at 9:30 a.m. EST. The algorithm often makes a quick false move in the first 30 to 60 minutes of the session. Just a classic turtle soup liquidity grab. And our entry comes after this false move as the market reverses back into the direction of trend. So as the examples that I showed you guys, you could have seen it happening a lot of times. So first of all, we have accumulation, manipulation, distribution. So usually what happens, this is the Asian session, London session, the New York opens also makes a manipulation, and after that a distribution. So it can happen in the first 30 minutes or 60 minutes or maybe even after 2 hours. But it usually occurs in the first 30 to 60 minutes of the New York open session. So knowing when to leave. A perfect trade isn't just about the entry, it's about the exit, right? While a target can be at a key liquidity point, the high or the low, we have a fixed rule for taking the profit that is 1 to 3 risk to reward ratio, and it just really takes out the emotion out of the trades and helps us stay consistent, because even if you get like 40% win rate, we don't want the 3 ratio, we're still going to be profitable. And the main goal is always to try to aim for 1 to 3. If you cannot really aim for 1 to 3, then a 1 to 1, 1 to 2 is good either way. The trade that you are trading doesn't allow a 1 to 3 ratio, then I just would recommend not trading it. The next episode is going to be about the failure swing pattern, the logic behind it, and how to enter on them. So anyways guys, I hope you found this video helpful. If you did, subscribe, turn on the post notifications, like the video, write any comments if you have questions, and I'll see you in the next episode.